Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at AIRO Group.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for traders who want a more structured chart setup. VIP Algos is built for TradingView and gives you access to premium AI-powered indicators, clean visual alerts, market structure tools, risk-to-reward planning, beginner-friendly education, setup support, and a private members community starting as low as $9 per month. If you are trying to improve how you read charts and manage trade ideas, VIP Algos can help make the process easier to understand across markets like stocks, forex, gold, indices, futures, and more. But please remember, trading is risky. VIP Algos is for education and chart analysis only, not financial advice. It does not place trades for you, manage your account, or guarantee results. Always manage risk, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
Imagine you're just looking at your portfolio, right? And you see this massive, just brutal 13.2% drop in a single day.
Oh, yeah. That's enough to make anyone panic.
Exactly. But get this, the company we're looking at today is quietly sitting on a $150 million secret.
Right, which is wild.
It is. That's exactly what happened with AIRO Group right after their Q1 earnings came out.
Yeah, the market just completely dumped it.
So today we are doing a deep dive into their Q1 earnings transcripts, some recent drone patent reveals, and the macroeconomic charts, basically to answer one big question for you.
Is this double-digit drop a massive red flag?
Right.
Or, the buying opportunity of the year?
Exactly, because it's a really phenomenal question.
It really is, because look, on the surface, the headline numbers just look terrible. The losses are widening, revenue's down year over year, and investors they completely panicked.
Yeah, they ran for the exits.
Right. But if you look just a little bit deeper, beneath that really dramatic washout, there is this massive $150 million defense and drone backlog.
Which is huge.
It's massive.
Yeah.
There's an immense amount of hidden value here that the broader market seems to be, completely ignoring because they're so hyper-focused on this one single quarter's headline miss.
All right, let's move into the wealth building context. Because, for anyone trying to build long-term portfolio growth, catching a falling knife is usually...
It's a terrible idea.
Yeah, a really terrible idea, unless there is a serious structural foundation underneath it. So what is the actual long-term play here?
Well, the core thesis for long-term investors is that this company is undergoing a very deliberate strategic transition.
Deliberate being the key word there.
Exactly. They aren't just shrinking or, losing market share by accident.
Yeah.
They are shifting their entire operational focus toward higher margin, highly scalable, unmanned systems.
Right, so we're talking about advanced defense technology and commercial drones.
Yeah, unmanned systems.
Which makes sense, because when you transition to unmanned systems, you fundamentally change the unit economics of the business, right?
Oh, completely.
Like, you no longer have to worry about life support systems or pilot training pipelines or just standard aviation overhead.
Right, it's a totally different game.
Yeah, you're building scalable hardware driven by software. But to do that, you need massive buyers.
Exactly, and that is where the macro tailwinds for the defense sector becomes so important.
Yeah.
Defense spending operates on these massive multi-year secular budgets.
And just to clarify for everyone, the word secular here means...
It operates independently of standard economic cycles. Like, the Pentagon doesn't just stop buying intelligence drones because, consumer retail spending slows down.
Right, which makes this what we call a defensive growth play.
Yeah, perfectly insulated.
Right. If you're looking at your portfolio right now and sweating over the broader economy, an asset tied to sovereign government procurement cycles is largely insulated from those short-term business cycle contractions.
It is incredibly resilient. When you're positioned in secular defense and logistics modernization, you are anchored by multi-year government commitments.
Not the whims of next quarter's consumer sentiment.
Exactly.
It actually makes me think of like a messy house renovation.
Oh, that's a good way to look at it.
Right, because if you walk into a house mid-renovation, it looks terrible. There's exposed wiring, drywall dust everywhere, no plumbing.
It's just a total disaster zone.
Yeah. If you just look at the mess, you'd think the house is unlivable. And that is essentially what that short-term Q1 earnings loss looks like right now.
A bunch of drywall dust.
Exactly. But you don't judge the house by the dust, you judge it by the blueprints. The structural upgrades they're making right now are meant for massive long-term value appreciation.
That is the exact mindset you need to have here. You have to take a thesis-driven approach.
Mhm.
It requires looking past the immediate, quarter-to-quarter noise
Right.
and focusing on the fact that they are stripping down these low-margin legacy operations to build out a high-margin futuristic tech stack.
All right. To understand if this renovation is actually going to work, now let's look at the fundamentals.
Let's do it.
Because we need to break down the Q1 2026 numbers. I mean, they're the reason the stock tanked 13.2%.
Yeah, they were rough.
Very rough. Sales were 8.9 million, and they posted a widening net loss of 15.45 million. That is a steep, undeniable year-over-year revenue decline.
It is steep, but and this is crucial, it was also entirely anticipated by management. Again, it's the drywall dust of that deliberate shift we just talked about.
Okay.
And the most critical fundamental signal, like the real bullish anchor here, is that despite that terrible Q1, management actually reaffirmed their full year 2026 revenue growth guidance.
Wait, they reaffirmed it?
Yeah, they reaffirmed growth guidance of 15 to 25%.
Wow. Which implies a massive back half weighted recovery.
Exactly. They are essentially telling the market, yes, the start of the year was painful while we transitioned, but the end of the year is going to explode.
So how are they going to execute that? I mean, it really comes down to their technological moat, doesn't it?
Absolutely. They have successfully developed a full-scale, autonomous, hybrid electric VTOL aircraft.
And for anyone unfamiliar, VTOL stands for vertical takeoff and landing. Think of an aircraft that can hover and take off like a helicopter,
Right.
but it flies with the speed and efficiency of an airplane.
And building a hybrid electric version of this is incredibly difficult engineering. You have to perfectly balance power-to-weight ratios.
And battery density constraints, yeah.
Exactly.
And alongside that VTOL, they unveiled their new RQ-70 Dane ISR drone.
Yeah, the Dane.
Right. And ISR stands for Intelligence, Surveillance, and Reconnaissance. But building the tech is really only half the battle here.
Oh, for sure. The financial anchor protecting all of this intellectual property is that $150 million defense backlog we mentioned at the start.
Which is just a massive number.
It is, and we really need to emphasize just how powerful a government backlog is. Because developing these platforms creates an immense technical barrier to entry. But the real moat...
It is the bureaucracy.
Yes. The bureaucracy. The certification processes, the security clearances, the rigorous testing required to get approved as a defense vendor. It's exhausting.
So you can't just, spin up a startup in a garage and compete with a military-grade drone.
No way.
Yeah.
It's impossible.
So government bureaucracy is actually their biggest asset. Once you finally get through the red tape and you are written into the budget, you are heavily insulated from lower-cost competitors.
Because the government doesn't like changing suppliers once a data link is trusted.
Exactly.
Yeah.
It's too much of a headache for them.
Right. And that incredible stickiness brings us to one of the most surprising fundamental developments of the entire quarter.
Oh, this part is wild.
Yeah. During this period of unprofitability, while posting a $15.45 million net loss, management actually authorized share repurchases.
Wait, they announced stock buybacks.
They did.
Okay, I have to stop and push back hard on this.
Go for it.
If they are losing $15 million a quarter, every single dollar matters, right? It's money flying out the door to fund operations. How can they justify literally buying their own stock instead of paying for drone parts or engineering talent? How does that math work in the boardroom?
I know, it sounds crazy.
Burning cash on buybacks when you are deeply unprofitable seems completely reckless to me.
It seems counterintuitive until you understand how share repurchases work mathematically and, more importantly, what it signals.
Okay, walk me through it.
Imagine a company is a pizza cut into 10 slices. If the company takes cash, buys back 2 slices from the public market, and retires them.
The remaining 8 slices suddenly represent a larger percentage of the total pie.
Exactly. It mathematically increases the value of every remaining share.
Right. I get that reducing the share float drives up the price, but why do it right now while bleeding cash?
Because of the signaling.
Mm-hmm.
Buybacks during unprofitability signal immense, almost arrogant management confidence.
Arrogant confidence. I like that.
It tells the market that the insiders, the people with perfect granular visibility into that $150 million backlog, run their internal valuation models and see the current stock price as absurdly discounted.
Oh, so they know something the market doesn't.
Right. It implies they know exactly when that government cash is hitting the balance sheet, meaning they have zero immediate solvency risks.
Because otherwise, the board of directors would never legally authorize deploying precious capital to buy back shares.
Exactly. They wouldn't risk bankruptcy just to pump the stock.
That cash burn is a real concern, though, which is why they need to execute fast. That brings us to the catalyst timeline.
Yeah, timing is everything here.
So what are we looking at over the next 3 months?
The primary test is going to be the Q2 2026 earnings, which are estimated to drop in August 2026.
And the market consensus is going to be ruthless on that one.
Oh, absolutely brutal. Wall Street is going to demand absolute proof of sequential revenue improvement.
So management has to show that they are finally converting that $150 million backlog into realized top-line revenue.
Exactly. They have to validate that 15 to 25% growth guidance they promised.
Alongside those earnings, we're also looking closely at the contract pipeline, right?
Yes. Now that they have formally unveiled the RQ-70 Dane drone and the hybrid electric VPO, we need to see the pre-orders.
We need to see follow-on contract announcements because typically in defense procurement cycles, you see major news flow 1 to 3 months after a massive tech reveal.
Right, and that catalyst pipeline is happening against a very tricky macroeconomic backdrop. We have a real divergence here.
Yeah, the macro is a mess.
We've got their secular defense momentum pushing one way, but broader macroeconomic headwinds pushing the exact opposite way.
Well, let's break those headwinds down because they are significant. The U.S. GDP was just revised lower to 1.6%.
Which is not great.
No, it means overall economic growth is slowing down. But at the same time, we have hot core PCE data.
And core PCE is essentially the Federal Reserve's favorite metric for measuring if inflation is sticking around.
Exactly. So if you have slowing economic growth but inflation stays hot, you get stagflation.
The worst of both worlds.
Right. And if inflation stays hot, borrowing money stays expensive because interest rates stay high. That usually crushes cash-burning, unprofitable companies.
Yep.
So my worry is this. Will a hot core PCE and high interest rates drag this stock down regardless of their specific defense contracts? When financial conditions tighten, the market punishes risk no matter how cool the underlying drones are.
It is a very valid risk, and it is exactly why I am so hyper-focused on that August 2026 earnings report as the key inflection point.
Because it proves the thesis.
Exactly. Because of the nature of defense budgets, they are shielded from that sluggish 1.6% GDP print.
Right.
If August proves that the $150 million backlog is finally converting to cash, the market will re-rate the stock based on its guaranteed contracted revenue.
So it will entirely bypass the macroeconomic noise.
Exactly, because government checks don't bounce when inflation runs hot.
Very true. So we have a clear timeline for these catalysts, but how is the market pricing all this right now? Now let's pivot to the chart.
The chart is wild.
It is. Following that Q1 earnings release, shares traded down 13.2% in a single day. From a technical perspective, this is what traders call a classic washout event.
Yes, and a washout is exactly what it sounds like. It is when all the weak hands, the short-term retail traders who are just holding the stock, hoping for a quick earnings beat, they just panic.
They see the headline losses, they hit the sell button, and they exit entirely.
Exactly.
Yeah.
It is always accompanied by unusually high trading volume and massive volatility.
Let me use an analogy here to explain why this is actually interesting.
Yeah.
This 13.2% drop isn't just a rubber band snapping. It is more like a forest fire.
Okay, I see where you're going with
It
it.
looks completely devastating on the surface, but it quickly burns away all the dead brush. In this case, the dead brush is all the short-term, fearful traders.
And by burning away that dead brush, the chart clears out what we call overhead supply.
Right. Overhead supply being...
It's a fancy term for investors who bought the stock at a much higher price, watched it crash, and are now sitting there praying it gets back to what they paid so they can sell and break even.
So they act as a permanent ceiling on the stock price.
Exactly. Flushing them out through this massive washout establishes a new, much lower support baseline.
It leaves fertile ground for new long-term investors to take root at a lower price.
Which creates a fascinating contrarian setup. From a flow perspective, that 13.2% drop on high volume means institutions are actively trading.
Wait, so institutions are buying the dip?
Well, because management signaled they are stepping in to buy the dip with their share repurchases, that institutional flow likely shifts. It moves from distribution, which is selling off, to accumulation.
So the smart money uses that high-volume liquidity panic to quietly build massive positions at a steep discount. The chart shows a climactic washout, but what does market sentiment look like beneath the surface? Because if you look at the immediate mood on Wall Street, it is overwhelmingly bearish due to that earnings miss.
The quantitative sentiment scores definitely reflect that short-term panic, yeah. But the qualitative news flow, like the actual fundamental developments, are highly constructive.
Like the drones.
Right. The unveiling of their VTOL and drone modernization places them perfectly in the crosshairs of future military and commercial logistics.
And then you have the strongest possible form of insider conviction, which is corporate action. We talked about the mechanics of buybacks earlier.
Yeah, talk is cheap on an earnings call.
Exactly. Talk is cheap, but a board legally authorizing capital to repurchase shares is a direct proxy for insider bullishness. They're quite literally putting their money where their mouth is.
We also have to factor in speculative catalysts, specifically M&A, mergers and acquisitions. Because CEO Joseph Burns didn't just talk about their current tech. He explicitly stated on the Q1 call that they are actively looking for acquisitions in the market.
Which brings up some very interesting sector comparisons. Just look at the broader autonomous space right now. Recently, a company called VisionWave invested $17.5 million into Foresight Autonomous strictly for their 3D perception systems.
And that is why this M&A speculation is so thrilling. 3D perception systems are basically the eyes and brains that allow drones to navigate autonomously in complex environments.
Right.
If you map that VisionWave and Foresight deal onto this potential future, the strategy becomes really clear. They could deploy capital to acquire complementary AI or perception tech firms to bolt right onto their own VTL and drone stack.
That makes sense.
If you control both the software brain and the hardware body of the drone, you exponentially widen your competitive moat.
Wait, hold on. I appreciate the enthusiasm, I really do, but I have to remain analytical here and push back.
Okay, let's hear it.
Acquisitions cost money, real cash.
Very true.
And as we already established, they just posted a $15.45 million net loss. If they start going on a shopping spree for advanced AI perception companies, where is that capital coming from?
That is the million-dollar question, and it is exactly why speculation is exciting, but we have to stay grounded.
Right. Now let's talk about the risks. Let's look at the bear case, starting with the first major threat to the thesis. Execution risk on this drone pivot.
That's a huge risk. Transitioning a massive company to scalable unmanned systems is incredibly difficult.
If this transition takes even a few months longer than management expects, the ongoing cash burn is going to back them into a corner.
Yep.
Instead of executing those authorized buybacks, they will be forced to raise capital just to keep the lights on.
And that leads directly into the second major threat, macro and dilution risk via M&A. Like we discussed, hot core PCE and slowing GDP are tightening financial conditions all over the market.
Borrowing money is really expensive right now.
Exactly. So if management's M&A ambitions, like buying those AI perception companies to build out their tech stack, are funded by issuing new stock rather than using cash, it could lead to severe shareholder dilution.
Exactly. I always say a backlog isn't revenue until it is delivered. Having $150 million in contracted value looks amazing on a slide deck.
Oh, it looks great.
But if they run out of runway, if they run out of cash before they can physically manufacture and deliver those drones to the government, the threat of dilution is incredibly real.
That is a very real threat. But, we have to balance those risks with the mitigation factors.
Okay, what are the mitigators?
Well, that $150 million backlog provides heavily contracted visibility. It significantly reduces the likelihood of a total growth shortfall because the buyer's already locked in.
The government is locked in.
Exactly. Furthermore, management wouldn't authorize share repurchases if they were secretly planning to recklessly dilute the stock to fund M&A.
That's a good point.
The stated interest in buybacks implies they are highly sensitive to their share count and their valuation right now. They know the stock is cheap, and they want to protect the equity, not dilute it.
So with everything on the table, the massive backlog versus the immediate cash burn, what's the final verdict?
Looking at the total picture, we are presenting a bullish score of 7 out of 10.
Oh, 7 out of 10, okay.
Here is the elevator pitch. This is a compelling asymmetric long opportunity following a massive 13.2% post-earnings overreaction.
The market just overreacted.
Completely. The market right now is acting entirely myopically. Investors are focused solely on Q1 drywall dust and losses, while completely ignoring a $150 million defense backlog, a reaffirmed 15 to 25% revenue growth guide, and deep insider convictions signaled by buybacks and M&A ambitions.
Right.
With their next-generation VTL and ISR drones, they are perfectly positioned to capture those secular defense tailwinds.
From a practical standpoint, the target horizon for this play is a 6 to 12-month hold. Specifically, you want to hold into Q3 and Q4 of 2026 to capture that back half revenue realization as that massive backlog finally converts to real cash on the balance sheet.
Absolutely.
But as we wrap up, I want to leave you with one final thought to mull over on your own. We talked earlier about that messy house renovation, how you can't judge the property by the drywall dust, you have to look at the blueprints.
Right.
The real question you have to ask yourself as an investor isn't just whether the blueprints are sound, but whether this management team has the tools and the capital runway to finish the build before the economic weather turns. The defense sector is incredibly lucrative, but the barrier to entry is high for a reason. Keep a very close eye on that August earnings report. It will tell us if the foundation is finally setting.
Very well said.
If you want to build a cleaner trading workflow, you can check out VIP Algos through the link below, starting as low as $9 per month. It includes AI-powered TradingView indicators, visual alerts, risk-to-reward planning tools, beginner-friendly education, setup support, and community access. Just remember, trading carries risk, no indicator can guarantee results, and every trade is your own responsibility. Use it for education and chart analysis, manage risk carefully, and make your own trading decisions. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.